Imagine standing in a room with two windows. Out of the left window, you see a world where a physical ounce of silver costs exactly $76.91. Out of the right window, that exact same ounce, mined from the same earth, costs $105.40. You aren't looking at a glitch in the matrix. You're witnessing the real-time fracturing of the global financial system. Right now, there's a $29.25 spread between the commodity exchange in New York and the Shanghai Gold Exchange. To put that in perspective, a $2 spread is rare. A $29 spread is mathematically impossible under normal market conditions. It's a 38% difference. It means the unified global market we've trusted for 50 years since the collapse of the Bretton Woods system is dead. We're now operating in two completely separate financial universes. If you're someone who's spent your whole life trusting the official numbers only to watch reality tell a completely different story, make sure to hit the subscribe button and give this video a thumbs up, because what I'm about to show you is the exact moment the illusion shatters. Look, hedge funds and massive institutional banks are staring at this spread right now. It should be the easiest, most risk-free arbitrage opportunity in the history of modern finance. You buy in New York for $76, you sell in Shanghai for $105, and you pocket the massive profit. But they can't do it. The smartest money in the world is completely paralyzed. And understanding exactly why they're trapped will change how you view every single asset you own for the rest of your life. Let's walk through the exact mathematics of this impossibility, because you have to understand the sheer scale of the profit that's being left on the table. If you manage a major trading house or a sovereign wealth fund, you have the capital to execute this trade right now. You could take 1,000 ounces of silver in New York. That costs you roughly $76,000. You put that physical metal on a secure cargo flight, you pay the transport fees, the insurance, and the logistics, which might run you about $2,000. You then sell that exact same 1,000 ounces of silver in Shanghai for $105,000. After deducting your costs, you just netted a $27,000 profit on a $76,000 investment. That's a 35% return on capital for what should be a completely low-risk standard logistics operation. Major institutions execute these types of arbitrage trades every single day with 8-figure capital allocations just to squeeze out a 1% or 2% yield. The annual profit from this silver spread alone would easily exceed $1 billion for a moderately sized trading desk. It's the closest thing to free money that's ever existed in modern financial history. Yet, the flow of silver from the West to Asia has actually dropped by 23% over the past month. The money's sitting right there, and Wall Street can't touch it. Why? Because sophisticated capital has slammed headfirst into a wall of systemic failure. Actually, it's 4 separate walls, and each one tells a darker story about the fragility of our global system. The first wall is physical supply exhaustion. This is the most straightforward but terrifying explanation. The physical metal is simply vanishing. In Western markets, current delivery timelines for institutional buyers looking to purchase 1,000 ounces or more are sitting between 16 and 20 weeks. That's not a standard shipping delay. That's an absolute supply shortage. You can't arbitrage a spread if you can't physically get your hands on the metal to ship it. Contacts within major Swiss refineries are quietly whispering that they've completely suspended new refining contracts for Asian delivery. They can't source enough raw silver at prices that make those contracts profitable. Western dealer inventories are currently sitting at roughly 8% of what they carried just 6 months ago, despite the price of silver rising significantly. High prices are supposed to bring out more supply. But the supply's gone. The Western vaults are running on the fumes of paper contracts, completely divorced from physical reality. The second wall is the silent weaponization of global supply chains. We're seeing government intervention implemented quietly without any grand public announcements or press conferences. According to shipping industry insiders, obtaining silver export permits from the United States and Europe into China used to be a seamless process that took 3 to 5 days. Now, those same routine applications are taking 6 to 8 weeks to process. Even worse, some applications are being outright denied under the vague and quiet banner of strategic material concerns. This isn't official policy passed by lawmakers. This is bureaucratic quicksand. It's administrative restriction implemented at the deepest levels, likely in coordination with national security agencies who are suddenly viewing precious metals not just as commodities, but as vital strategic assets in a world marching toward geopolitical conflict. The third wall is the deliberate disruption of banking and settlement infrastructure. Let's say you actually secure the silver and the permits. You still have to move the money. Major Western banks are now quietly delaying wire transfers above $5 million to Chinese precious metals entities. A standard international wire that used to clear in 2 days is now taking 2 to 3 weeks. In the fast-paced world of arbitrage, a 3-week delay makes timing the market completely impossible. And even if you manage to execute the trade and make your massive profit in Shanghai, Chinese capital controls have tightened like a vice. You can easily convert your profits into yuan to use within the Chinese economy, but repatriating those profits back into Western currencies like the dollar or the euro requires government approvals that are becoming almost impossible to obtain. It's a financial roach motel, The capital can easily go in to chase the silver arbitrage, but the profits can't get back out. The fourth and final wall is the absolute terror of regulatory and exchange uncertainty. This is where the psychology of fear paralyzes the smart money. Have we all forgotten the nickel crisis of March 2022? When a massive Chinese short seller was about to be wiped out by skyrocketing nickel prices, the London Metal Exchange literally retroactively canceled perfectly legal trades and shut the entire market down for 6 days. They sacrificed the profits of the traders who made the right call, just to protect the systemic players who made the wrong one. Now, look at silver. When you have the Shanghai Gold Exchange and the Commodity Exchange in New York both holding sweeping emergency powers, no hedge fund manager in their right mind is going to risk billions of dollars. They know the exact moment they establish a massive arbitrage position, the exchange will simply change the rules mid-game. They'll alter margin requirements, rewrite delivery procedures, or just unplug the servers. The free market is an illusion that's only maintained when it's convenient for the people who own the casino. When all four of these barriers operate at the exact same time, arbitrage becomes physically, legally, and financially impossible. The spread isn't being ignored. It's being forcibly prevented by the systematic breakdown of global trade infrastructure. But if you really want to know how this specific story ends, you have to look backwards. History doesn't just rhyme, it stutters and repeats the exact same catastrophic mistakes because human greed and institutional arrogance never change. We've seen this exact pricing dynamic before, right before one of the most violent wealth transfers in modern history. We have to talk about the London gold pool. From 1961 to 1968, 8 of the most powerful central banks in the world colluded to forcefully peg the official price of gold at exactly $35 per ounce. Whenever the free market tried to push the price higher, these central banks would dump their own physical gold reserves into the London market to suppress it. They maintained an artificial reality through sheer institutional force, but reality always collects its debts. While London traded paper gold at a strict $35, private physical markets in Zurich, Paris, and Hong Kong were quietly trading gold at significant premiums, often reaching $42 to $44 per ounce. The mechanism was identical to what we're witnessing with silver right now. The official market maintained a fake price through institutional selling, while the private markets reflected the actual physical supply and demand. By early 1968, that spread represented a 20 to 25% premium for physical gold. The sophisticated investors of that era recognized that the official London price was a complete lie. They happily paid the higher premium in Zurich because they understood that artificial price suppression always ends in a violent collision with reality. Today, the structural setup is identical, but the fuse on the dynamite is dramatically shorter. The Commodity Exchange in New York is playing the role of the London gold pool, suppressing the price of silver through endless paper contracts at $76. Shanghai is playing the role of Zurich, reflecting the true, brutal physical demand at $105. The spread dynamics are even worse today, sitting at a massive 38% premium compared to the 25% premium in 1968. And the arbitrage prevention is exactly the same. Physical delivery constraints are preventing the markets from balancing out. But there's one terrifying systemic difference between then and now. In 1968, it took 7 years for the London gold pool to collapse because the central banks had thousands of tons of sovereign gold reserves to bleed into the market. Today, there's no massive central bank reserve of silver to dump into the system to keep prices low. The Federal Reserve doesn't hold strategic silver reserves. The United States Treasury doesn't have a magical silver stabilization fund. When the paper illusion at $76 finally breaks, there's absolutely no institutional backstop to slow down the upward explosion. This suggests that the silver repricing event could happen in a matter of weeks, rather than the years it took for gold in the 1960s. This $29 spread isn't just an anomaly for silver bugs to obsess over. It's a real-time screaming indicator of how the global financial system is fracturing. What we're really witnessing is the accelerated, undeniable reality of de-dollarization. Look at the raw psychology of it. When major Chinese institutions are willing to pay $105 in their own local currency for a commodity that's theoretically available for 76 United States dollars, they're making a profound statement. They're effectively paying a 38% penalty just to avoid using the dollar-based system. They're looking at the massive debt, the money printing, and the debasement of Western fiat currency, and they're calculating that paying a massive premium today is far safer than holding onto dollars tomorrow. That's true de-dollarization in action. It isn't just about trade agreements. It's about a total collapse of psychological trust in the dollar as a reliable mechanism for pricing reality. Furthermore, this points to a world of financial balkanization. The integrated global financial system that's allowed free trade to flourish since the 1970s is splitting into regional blocks. They're operating with different rules, different trusted institutions, and completely different pricing models. Silver is just the canary in the coal mine. If the mechanisms that keep silver markets integrated are quietly failing, what prevents the exact same breakdowns in the global markets for crude oil, copper, or agricultural products? We're looking down the barrel of 4 very specific ways this crisis resolves, and how it resolves will dictate whether you experience the financial opportunity of a lifetime or a catastrophic loss. The highest probability outcome, which I place at roughly 45%, is that Western prices explode upward. In this scenario, the paper market in New York finally admits defeat, and the price rockets from $76 toward the $95 or $105 level to match physical reality. This could be triggered by a major delivery default on the exchange, or inventory dropping below critical levels, sparking a panic among industrial buyers who suddenly realize they can't get the metal they need to build solar panels and electronics. The timeline for this initial violent move could be just 2 to 6 weeks once the panic sets in. If this happens, physical silver holders will see massive appreciation, and the standard exchange-traded silver funds will see explosive 20 to 30% gains overnight. The second scenario, with a 25% probability, is that the Shanghai prices collapse downward. Perhaps Chinese physical demand moderates, their manufacturing data slows down, and the price drops toward $85 or $90, closing the gap from the top down. If that happens, the silver bull thesis is weakened, and the premium normalizes back to a historical 2 to 5%. The third scenario, sitting at a 20% probability, is a terrifying permanent market fragmentation. The global silver market officially splits into an Eastern physical market and a Western paper market, and they never reconcile. This would happen if geopolitical tensions between the United States and China escalate to the point where normal trade is permanently severed. In this world, the location of your physical silver becomes just as important as the silver itself. An ounce stored in Singapore might be worth vastly more than an ounce stored in New York. 2 completely separate investment ecosystems would emerge. The final, darkest scenario at a 10% probability is a system-wide market breakdown. The silver spread triggers a contagion that spreads to other commodities. We see major exchange failures, currency system breakdowns requiring emergency central bank intervention, and a total freeze of global trade. In that world, standard diversification fails completely, and only physical assets held in your own hands in secure jurisdictions will preserve your purchasing power. Given this level of extreme uncertainty, your positioning is everything. If you hold physical metal, you have the ultimate flexibility. You must verify exactly where it's stored, because metal stored in Asia-friendly jurisdictions will command that massive premium. If you're holding significant profits on silver you bought years ago, it might be wise to trim 25 to 30% of your position at the current Western prices just to lock in gains, while holding the core position for the upward explosion. If you're holding paper products like standard silver exchange-traded funds, understand that these track the Western market. They'll benefit massively if the New York price explodes upward, but you must establish strict stop-loss limits below $72 just in case the spread resolves in the wrong direction. And if you're entirely new to this and looking to establish a position today, don't dump your entire life savings in at once. The volatility is too extreme. Favor physical metal over paper contracts and strictly cost average your purchases over the next 8 to 12 weeks. The $29 spread is the universe screaming at you that the old rules no longer apply. Wall Street is terrified, the exchanges are trapped, and the physical metal is draining. The $29 spread isn't just a warning bell. It's the sound of the global financial system fracturing under the weight of its own paper illusions. We've spent half a century pretending that a derivative contract is the exact same thing as the physical asset it represents. But physical reality is finally calling the bluff. The smartest money knows the end game is here, and they're quietly preparing for the collision. The only question left is whether you'll be caught holding the paper or holding the truth. If this changed how you see the silver market, hit the subscribe button and check the links in the description to verify the data for yourself. The truth is out there. Your job is to act on it.